fixed income money market securities. Now we have learned about the two main means of a company to obtain capital. Okay, remember that a company obtains capital for its assets, right? And they do that either by issuing equities in the IPOs, which makes up their equity portion in their balance sheet, and they will also have liabilities which are incurred when they issue bonds. Alright, so these are made up of issuing bonds, and this one is from issuing shares, alright, or equity. However, bonds in this case is typically a long-term mode of borrowing. For example, you see 2-year bond, or 5-year bond, or 10-year, or even 20-year bonds. Okay, now if say the company needs to borrow in the short term, okay, where does it get its money from? A bond issue takes several time. You have to find an underwriter to do it, and that will take time. So where does the company turn to for short time funding obligations? Okay, since doing this would be time consuming, and issuing bonds as well would be time consuming, the answer is we turn to money market securities. So money market securities, or we call it MMM for short. So MM securities, right, they are short-term, okay, and they have maturities of typically less than 1 year. Alright, they're issued by governments. We have central banks, banks as well, and other financial institutions, and even corporate companies, right, to meet short-term funding needs, right, to meet short-term funding needs. So the funding needs, okay, are short-term, and this involves borrowing or lending money for typically less than a year. Now, because of the money market securities, okay, massive sums of capital can be transferred rapidly from one economic unit to another for short periods of time. So we can have banks lending to government, as well as government lending to banks, and vice versa for all of them. Okay, so they can lend to one another via money market securities for short periods of time. So the advantages that money market bring to people is for the borrower. Obviously it can borrow money quickly to fund its short-term needs, and also for the issuer of, or the lender in this case for money market securities, it can maximize their returns by lending money which they are currently not using. So rather than keeping the excess money in a bank account, they can actually lend it to the borrower at a higher interest rate. Okay, so this is putting excess cash onto use. Now the maturities of money markets I've mentioned, less than a year, and they actually range from overnight to tomorrow night, to days, to weeks, to months, okay, and maximum being a year. Okay, they are typically liquid. All right, there's buyers, and there's borrowers, and there's lenders for money market securities. Okay, it has high credit quality, which means that there is low default rates on from borrowers, okay, and the amount that is borrowed or lended in money market securities are typically in the billions. Okay, huge amounts. And active secondary markets, they allow most money market securities to be sold prior to maturity if a need for cash emerges by the lender. Now, money market securities, okay, they are typically quoted on a discount basis, which is if you buy a money market security at maturity at an interest rate of 5%, 5.0%, and maturity in 40 days. That means in 40 days time you get $100. Okay, it's always quoted on a par value of $100. Okay, the money market security will be priced at $99.44. Alright, so this is how money market securities are quoted. Alright, they're quoted on a discount basis, which is you get $100 and always $100 at maturity, and based on the number of days and what is the interest rate, okay, the money market security will be discounted. So this we will go through the formula for this discount later.